Chris.
Good morning, Anthony.
Good morning.
We've been firing dad jokes this morning. I'm laughing at my own jokes. If this wasn't Zoom, Chris and I would be telling pull my finger jokes the whole podcast. That's why we do this over video. Yeah, it's fair. I think it's a good point. Also, today we're talking about financial statements, but did you hear about the guy who invented the hay baler?
No.
He made a bundle.
Emotional, damn it.
Oh my God.
That was
Anthony,
terrible.
Are your financial statements gathering dust while golden opportunities slip through your fingers? Are they? Maybe. In 1929, just before the infamous stock market crash, a little-known investor named Jesse Livermore noticed discrepancies in financial statements the others missed. While Wall Street celebrated, Livermore spotted troubling patterns in corporate balance sheets and shorted the market. When the crash came, he made $100 million, equivalent to $1.5 billion today, because he understood that financial statements tell stories that most people can't hear. Today on How to Founder, we'll be talking about understanding financial statements. I'm Chris Franks. With me today, as always, my funny looking, funny smelling, funny everything co-host, Mr. Anthony Franco. And we're joined by Sarah Webb. She's a forward-thinking fractional CFO. Sarah Webb helps attorneys build profitable practices through strategic financial management. Beyond handling day-to-day accounting, Sarah and her Webb CFO team transform numbers into powerful decision-making tools, providing both tactical support and forward-focusing strategic planning. Sarah, welcome. Thank you for joining us. Sorry about all the dad jokes this morning. I'm not that sorry.
No, it's great. Thanks for having me.
What's your best dad joke, Sarah? You got a good one?
Oh gosh, I cannot come up with a dad joke off the cuff. That's a different department. As I said, I have a son and a husband, and they're in charge of that. So
they handle the dad joke.
They are responsible for the dad jokes.
Right. I'm the department of one in my house of dad jokes. Even though I've got two sons, they just look at me like, ugh. All right. So let's just talk about this.
A lot. So
yeah. Give me an overview here. What do I, as a founder, what do I need to start caring about? I think that we were kind of joking before that a lot of founders don't even really know what a balance sheet is. We know what our cash is. We know their cash on hand. But why is it important that we start to understand what are the financial statements? What are the things that I should be looking about and understanding as a founder?
Yeah. So I always direct people to three basic statements: the P&L, the profit and loss statement, the balance sheet, and the statement of cash flows. And that really gives you a holistic story of what's happening in your business. The three of them working together. I think the statement of cash flows probably gets ignored the most, but if you're a business owner and you're a young founder, it's the equivalent of kind of like going and checking your bank account each day, right? Like, what do I have in the bank that I know is going to go out the door, or what's coming in, or who's paying you? So always start with those three. The P&L is everybody's favorite, honestly, because it feels sexy to be able to look at your revenue number and see, okay, is it going up or is it going down? And the P&L is a measure over a period of time. And so it's not just this single one-day transaction. And really it's kind of a measure of, what you're bringing in and what you're spending. Where the balance sheet is a snapshot in time. It's one day. This is on this day. These are the balances of each of these accounts. When I review financial statements, I actually always start with the balance sheet because I feel like that's where the most errors can occur if things are not reconciled, or if you're doing accrual accounting, you might have some prepaids or some accruals that need to be reviewed. And then I go over and look at the P&L, and I always look at it on a month-to-month basis to see kind of how things are trending. When you're really tiny, 1 month you paid the utility bill and 1 month you didn't. Those types of gaps in, looking at it side by side by month, you can see where you might have spent some money in a prior month that you didn't spend this month.
Wait, back up for a second. Accrual method. What are the methods of accounting, and what are the differences?
Yep. So cash is king, right? So cash is the most basic, what came in minus what went out. That is a cash basis. Most taxpayers, especially small businesses, are cash basis taxpayers. But accrual accounting that's like moving into generally accepted accounting principles, GAAP. Those are companies, let's say you're in the millions at this point, is most likely when you might consider moving to accrual basis. And depending on your financial software, it's literally like a click of the button to change the views. But accrual, the typical accounting example is insurance, right? A lot of times you pay insurance all at one time and it covers you for 12 months. And so if you were on a cash basis, you would be recording that in the month that you paid that insurance bill. But if you were on the accrual basis, you would be taking that insurance and dividing by 12 and every month reporting just a portion of it so that it's matching the period that you're actually being covered. Most companies start like at the founder level, unless you're trying to get an IPO or you have outside investors. You start as cash basis, and depending on your business needs, you might move to accrual basis in the future.
Why would you care about accrual basis over cash basis?
I normally convert people to accrual basis because I'm nerdy and I can easily do it. But really, the advantage of accrual basis is that it's telling you the income as you've earned it, your income and expenses as they're being earned or expensed versus just the statement of cash flows or just the cash of what's in and out. I like to know, let's pretend you perform some type of service and you pay all your team to do it, but you don't get paid for 60 days. Well, then the expenses are in 1 month, but the payment that you're receiving is 60 days out. So the revenue is in that other month. What the accrual basis does is it's matching up the income with the expenses in the same time period.
So I think that it's funny. I want to ask Anthony about, when you started, Effective or even MC Squares, you started this thing, and really those first year or two, it was just about how much cash you had in the bank. And suddenly sales started coming in, and suddenly things got a little bit more complicated. When did you, Anthony, start looking at things other than just your balance in your Wells Fargo account?
It gets even more complicated with MC Squares because I had financial statements from Amazon that I had to incorporate into my own accounting software, and Amazon fees, and when they took their fees and when I paid them, it became very complicated very quick. And so I had an expert do it. I looking at my P&L on a monthly basis, we would look at our P&L, but understanding the nuances behind it was so complicated and so technical that I had to rely on an expert to manage that for me.
I remember, when I started to actually look at my balance sheet, it was a good day. It's like, I've got enough cash here. I'm not worried about next payroll. I wonder what my balance sheet actually looks like. Oh, okay. That's, it's somewhat interesting, as opposed to, constantly just being like, okay, what's coming in, what's going out, what's coming in, what's going out. All right. So I think that probably the biggest question to start with, Sarah, is what mistakes do you see the most? Where do you see us as founders falling down, and really particularly early stage? If you screw things up early, it costs way more to fix them in year 3 and year 4 and year 5. Even just setting up QuickBooks wrong can be kind of a nightmare. So what are the mistakes you see for early stage, and then how do you fix them?
Yeah, I think it's striking the balance between doing everything yourself and then hiring an expert that can overcomplicate things, right? Like, so there's a balance in like, you're trying to save money, so you want to do as much of it yourself, but you also don't need to abdicate so much that you don't know what's going on in your business. And so specifically with the finances, I see a lot of founders either do nothing and like, they don't even have a accounting system like QuickBooks, and they're just going to like print their bank statements at the end of the year and give them to their tax person and hope for the best. So that's like the extreme. Like, we don't want to do that. And then the other is, I've hired someone so I don't have to worry about that. And no one cares more about your business than you do. Like, as an accountant, I care about your business, but if you can't make payroll next week, unless I'm your fractional CFO, like I'm not your bookkeeper, right? Like a bookkeeper is someone's just kind of recording transactions historically. Someone has to care about how you're going to make payroll or how you're going to collect from your largest client. And if you are the founder and you push all of that to accounting and you don't have kind of a partnership with that, things are going to get missed, and you're honestly not going to know how to run your business. Like, what if you get mad at that accountant? And I don't need you to be an accountant, but like, you need to know how people are generally getting paid. Are you writing paper checks? Are you doing ACH? Who are your biggest vendors? Do you have to go to a special portal for them to get to pay them? And how do you collect money? To me, that's the number one. Like, and as a founder, you know who your big customers are, but as it's kind of like, as you're getting further away from like the day to day, you still need to have a good idea of what's happening over there, even if you're not an accountant.
Anthony, is this one of those things that, we say that you can't outsource sales early on? Like, you have to be that as a founder. You kind of have to be the early stage bookkeeper. You have to be the person that sends out the invoices and understands what's coming in, what's going out.
So bookkeeper, I wouldn't go to bookkeeper, but you have to have an obsession with your financial statements. You have to, looking at your bank balance. Like, I know some founders that they take the blinder method for financial statements. If I don't look at it, it's not that bad.
Yeah.
That is a guarantee if it's going to get really bad very fast. You have to look at it. I looked at KPI numbers on the financial statements on a daily basis, and how sales, because sales came in every hour on an e-com business, and that's different than if you're running a services business that invoices their clients every 30, 60, 90 days. You're not having to keep a pulse on it on a daily basis necessarily, but you do. You're right, Chris. If you don't, and Sarah said this best, who cares about making payroll? Whoever cares about making payroll is the person that should be reading the financial statements and at least understand, and look at some, be able to look at some. I guess what it is if you're looking at it at least every month, but hopefully sooner than that, you can spot something in your P&L and go, wait, that doesn't make sense. And that gives you something to dig into. If you're not looking at it at a regular basis, how do you know what makes sense and what doesn't? So you kind of have to develop intuition on your balance sheets. The only way, and income statement, the only way to do that is to be in them every so often.
Yeah. I mean, I think add, once a week.
Yeah. Well, I would add, so the person that you have as your bookkeeper or the accountant at the beginning needs to really have the heart of a teacher, right? So like, they need to have the technical skills, but they need to come to you and like, you're going to have questions as a founder, right? Like, you haven't done this before, most likely your first time, you don't know the questions to have, but what you're looking for them is to tell you a story. What are these financials telling me? So if someone just sends you a set of financials and it's like, peace out, like, that's not a partner. That's not a business partner, right? They need to say, okay, here's what I've noticed in your financial statements. I noticed that this happened month over month. I noticed that this vendor has not been paid. I noticed that this guy we need to be collecting from. Like, what are they like? Yes, you just don't want someone to like kick it over the curb. Okay, here's your financials. Have a good life. No, like, what is that story that it's telling you? And you, as the founder and the operator, you can say, whoa, that doesn't make sense that person is 60 days past due. Let's go back and check that. Or maybe I need a call. Like, you kind of have to have the leadership to have the gut check of like, that doesn't make sense to me. And it doesn't mean that it's wrong, but you have to be able to have that questioning and that relationship with your accountant or bookkeeper to say, let's double check this, or can you explain this to me? And I always try to say, like, explain it to me like I'm a kindergartner. Like, if I can't explain it to you in the simplest terms, either means I don't know what I'm talking about or I've made it overly complex.
I think it's a great point. Also, yeah, I think finding the right person in that role is so critically important. I've done it both ways. Like, I've had unbelievably great people that have served in that bookkeeping role, and I've had people that just weren't a good fit for me personally. They just bugged the hell out of me. I want to ask kind of one big clarifying question here, which is, by definition, and this is business school definition. Business school definition is accounting is about looking backwards. Accounting is typically a controller, and then you have finance. And finance is a different animal. Finance typically is more forward-looking. It's looking at projections. It's looking for pro formas. Typically, for founders, we just sit in the seat more of kind of the accounting and bookkeeper role. When do we need to start thinking more about forward-looking and finance and the overall more strategic role that money plays in our business?
I think when you get to the point where you're past the initial testing, right? Like that first 6 months to a year, depending on the runway of the business, like you're just experimenting, right? Like you're trying to figure out what works. And so once you're like, okay, this is working. I am able to make money. I'm able to pay people. What am I trying to do with this? And when you've kind of like, you're past survival, right? Like you've figured out, okay, I can survive. I can eat now. I have a shelter. What am I trying to do with this company? Am I trying to grow this? Do I need to have capital investment? Any of those like future forward, besides like just cranking the machine and doing the same thing over and over. There's a lot of people that want to do the same thing over and over, and they make a lot of money doing that. Like, and that is fine. Maybe they never need a CFO forward thinking person. But if you're the heart of a startup, a heart of the founder, like there's never enough, right? You're always trying to build and grow because that's your personality. And that's like your business model can support that. That's when after you've, tested, I am going to survive, then that's where you get involved with someone who can help you map out that plan for the next 2, 3, 5 years.
Anthony, one of the things that strikes me as Sarah's talking about this is how little founders know, and I'm talking experienced people that have done this a long time, actually know when to take money out of their business and what are the tax advantages of that. And we tend to just be these people that are like, hey, we're building a asset, we're building something of value, and so I'm not going to be taking any more money out than my little bitty salary that I'm taking from the company because I just want to put everything back in. That could be a big mistake, Anthony. Have you ever made that one, or do you know somebody who has?
Every single one of my businesses that I've been a part of, all of them looked like that. Yeah. where I took a modest salary and just kept pouring back into the business. And most of the time that worked out really well. But I think you're right, Chris, in that that's not the right call for everybody. Especially if like I start and exit businesses. That's what I do. Right. And so that kind of makes sense because you're trying to grow it to an exit value. If
you're way oversimplifying. You tell dad jokes. You've got terrific hair. You do a lot of other things other than just start and exit. Like
that's it. No, that's it.
Give yourself some credit, Anthony. You watch a lot of Seinfeld too, so
yeah, I watch a lot of Seinfeld. But for somebody that's building a more reasonable business, a more reasonable entrepreneur, it definitely makes, so this is, now you get into tax implications and you need a CPA and probably a tax attorney, a wealth management person. Like you kind of need a team around you to decide how you can best take advantage of tax laws and set yourself up for retirement going forward. So the way I do it is not the way everybody should do it, for sure.
And so, Sarah, I mean, I guess kind of the question, I know we're getting a little bit off track about looking at financial statements, but I think it's important, which is you're now asked to come in to a company to consult with a company, let's say, 3 to 5 million. Is that kind of top line? Is that usually when you get called in? And you're coming in. How do you address the founder in the room? Not the elephant, but the founder, which is you kind of got to make sure they're okay financially. For the business to be okay, they need to be okay. How do you address that?
Yeah, so we take a few steps back and really, like Anthony, you said you build an exit. Like, what does that look like for you and your family as a long term, right? How old are you? When do you want to stop working? Ideally, right? Some of us, we want to work forever, but we got to put a number on it. So to me, it's all about stepping back.
126. That's my number.
126.
Yeah.
But to me, it's stepping back to like, what is that personal goal? What does that number need to look like? And, we're not financial planners, but we can rough it. We can say, okay, this is what it would take to live off $200,000, $300,000, $500,000 a year. Okay. Now, are we building this asset to get you to that number? Yes or no? Or do you have other assets that you can compound on that? When you talk about legal entity structures, a lot of my organizations, they want to own the building that they're in, right? Like that's part of their wealth plan. I'm going to buy a building. I'm going to pay that off. I'm going to work here. And so we kind of look at all the building blocks of what is getting you to that end goal, and build it from there. So it's so to your point of like what that salary is, like we come in, I guess I have entrepreneurs that do the other thing. Like they take all the money out of the business and they pay themselves everything and then there's nothing left. So we try to come up with a reasonable, honestly, we come up with a formula because formulas don't have opinions. So we come up with a formula and it's like, this is how you're going to be paid each month. And this is the formula that we're following. And we put that into the business. So whoever's doing it, Anthony doesn't come by and say, oh, this month my family's going on vacation. I need an extra $20,000. No, like we stick to the formula.
Wow. Where are you going on vacation? Holy cow.
I'm dreaming of a vacation.
No, she went to Costa Rica.
Yeah. I did go to Costa Rica. It did not, you can go not for $20,000, but what if you're going on some safari of once in a lifetime trip and you just kind of like walk by accounting and you're like, oh, I want to do this. Like we have a lot of people who treat the business as their own piggy bank. And so once we put in the formula, it's like, nope, this is the formula that we've all agreed to. This is what it is. And sometimes, you may think, oh, I really wanted to reinvest this. No, the company needs to be paying for that. What would you make as the CEO in a comparable size business? And that's kind of where we start with what this formula looks like.
So let's get tactical, Sarah. We're as early stage founder, you kind of said it early, you need to invest in some sort of a system, avoid the shoebox and the dumping all your things in there or just handing your bank statement, which also has your personal expenses, mixed in there as well to your account. That would be a bad approach. So early stage QuickBooks mostly for founders. Would you pay somebody to set it up right?
Yeah. I mean, I think you can pay, let's say $2,500, $3,000 to have it set up correctly. From there, you can decide how much you want to do yourself. It is fairly automated and it can be learned. It's more a value of your time, right? Like, is this the highest use of your time? But QuickBooks works for most startups. And then depending on what kind of business that you're in, you can move to a more advanced system. I would say QuickBooks is not great for inventory. It's kind of, that's to me, like you're into
that
like a
true.
NetSuite. It's not for an inventory business.
NetSuite. Oh my gosh. NetSuite is worse.
You can make more.
Don't get me started on NetSuite.
But if you're a service-based business, like in the very beginning, QuickBooks is going to work just fine for that. I think inventory is the biggest piece. You can I have some companies that have kind of like an inventory management system related to their industry, and then they feed that to QuickBooks. And so, they're kind of having two systems, but yeah.
I just try to avoid anything that has significant cost of goods sold, Anthony. Like you actually built things at MC Squares. Like there was cost associated with it.
Yeah, there was. We did inventory. You know, Sam Bankman-Fried's company. Was it FBX?
Yeah,
Yes.
right. The crypto exchange. Yeah.
Multi-billion-dollar company. They ran on QuickBooks.
Really?
Yeah, they ran a now.
That's also
not,
why
that is obviously not the model, right? But yeah, that was one of the findings. They're running this crazy multi-tier, different entity, billions of dollars crypto business, and they're using QuickBooks as the back end. Crazy.
It's weird that he's in jail right now. I think I just heard that he was hanging out with like P. Diddy or something.
Yes,
I just saw that. Yeah.
They've corresponded and they're giving each other tips. I was what I was reading.
Oh, that's terrific. All right. So next phase as we go along, we were trained as high growth founders and people that are getting VC is to keep a founder book where we pull our financial statements every single month and we kind of file them in a physical binder. I don't think we do that anymore, but what are the steps that you need to take as you're going and growing? What statements are you collecting? And even before I hire you, what am I looking for in those kind of growth stages?
Sure. Nothing is more painful than due diligence. Okay. So the fact that you're even thinking about that at the beginning is, putting you as a high growth founder ahead of everyone else. I would say any kind of documents that you get from your attorney. I mean, I have what I call an organizing documents folder, and it's exactly that, right? It's all my Secretary of State filings. It's my initial payroll logins in case something happened. I mean, all of those initial papers, I put those in what's called an organizing documents folder. And then I don't do the month to month on they're saved somewhere out in the cloud. But when I'm thinking about due diligence processes I've been through, they're not most of the time since the beginning, they're not looking at month to month. They're looking at annually. The month to month is really like the last 24 to 36 months. And so to me, it's kind of like the vault. You're just putting it in there, knowing that you're going to need to pull it out that someday. I would come up with a naming convention. I mean, I've spent hundreds and hundreds of hours and hundreds of thousands of dollars helping people get organized for this. And so the more organized you can be at the beginning, you're going to save yourself so much money. If you come up with something simple like a naming convention for your folders and your files. I know that seems silly, but like people like me, when I was a baby accountant, had to go and like rename everything. And nobody wants to pay $500 an hour to have some intern rename a file. Okay. Yeah. So I would say be as organized as humanly possible.
Anthony, as an early stage founder, even before maybe I have a bookkeeper that I've hired, how do you set aside a meeting for yourself, even if it's just you, to review your financial statement every single month? How do you stay disciplined?
I've run a board meeting by myself. That's really awkward.
You're out of order. Very stickler for the rules.
The exact opposite. I just have a repeating calendar thing in iCal. I live by my calendar, so that it works for me. Where I set aside 2 hours a month to go to run my books, and 30 minutes every 2 weeks to run payroll. That's kind of how I do it at early stage.
I like it. Okay, Sarah, as we're growing, what are the next things we need to be thinking about? How am I now starting to spend a little bit more time and energy digging through some of those, like we said in the open, where are we trying to find the hidden gems, those pockets where we can run our business more effectively?
Yeah, I mean, I think as a founder, you're so focused on growth and revenue, which is great. You have to have that. I see founders kind of taking their eye off the ball on expenses. Think recurring type subscriptions. I mean, I had a company that had 2 telephone lines for 5 years and they didn't even know the second one existed. Things like that you set up at the beginning and you think you're going to use forever. I mean, at least annually, probably at the very beginning, every 6 months, going back through those expenses. Do I really need this? Is this contributing to revenue? And sometimes you're like, yes, I need this. I'm not trying to like make you inoperable, but there are things that you think that are going to be really helpful at the beginning I paid for this expensive CRM and I'm not even using it. Either cancel it or downgrade. Those are the types of things that I see people kind of take their eye off the ball because they're so focused on the revenue.
Anthony, that's ubiquitous in our world, is that people, the best entrepreneurs in the world are laser focused on cost. And you see so many people that are just like, sure, spend it on these high growth stages.
There is a point. I'm gonna be slightly contrarian here and just say revenue cures all. You can only cut so much. So it is appropriate to be very revenue focused. But I like Sarah's point where it's like, yeah, but go back and revisit, kind of like do a mini doge of your company, right? Every once in a while and go through and cut things that don't make any sense. Chris, don't shake your head. I'm not being political. I'm just saying.
I'm going to start making you do push-ups every time you say the word doge.
But she makes a really good point to revisit those expenses and make sure that you're not spending things that you shouldn't be, like a subscription or most of it actually comes down to subscriptions, right? Right. Sorry. Most of the things
to me, it's recurring things that you thought you were going to not. And I would say revenue does cure all, but revenue covers a lot of sins. And so if you're able to free up the sins,
you can be incredibly sinful with good revenue. Exactly right.
That's more money. That's more money for you. That's more money for you.
Yeah, I agree.
So that's kind of where, but to me, it's the recurring type of transactions, or, you're not old enough, like in this stage of your business, to be like, we've always done it this way, but you don't want to be that person, right? Like you don't want to look back in 3 years and be like, oh goodness, we've always done it this way. That's not the kind of business you're trying to create when you're in this phase.
Yeah. If you're not going to make payroll, right? If you're looking at next month and you're not going to make payroll, there's 2 ways of making payroll: cutting or growing revenue. Oftentimes growing revenue is easier.
Yeah.
I think it usually is, but as per usual, you're completely wrong, Anthony. A founder of this stage needs to know where every single penny is being spent.
Oh, I'm not saying that that's not true. I totally agree with that. Yeah.
And you need to ask questions about like, hey, I will absolutely invest in whatever tool is absolutely necessary to do our job in the highest way we possibly can. But if it's not completely necessary, it's going away. Like we're canceling it immediately.
Well, and I would say there's a third way to make payroll is to put off vendors or collect faster, right? So don't necessarily, yes, you can go make more money. Yes, you can cut, but what are the sideways? Like who can you offer a 1% discount to collect faster? Or who do you just need a stiff arm and say, I'll pay you in 2 weeks?
Or call somebody's mom and tell them that they haven't paid their bill yet.
Yeah, that's always a good thing too.
I was going to say it's also the reason why you should never focus on startups as your target market, because they never prepay your bill. It's never a good idea. All right. So now when do we call you and what? So we're now $3-4 million in revenue. We've organized, we know what we're doing, but it's time for us to make a plan. What are the steps I need to go through? And then how should I go about hiring a fractional CFO? When should I do that? Who should I hire? Walk me through that thinking.
Yeah. So I think, after you've had proof of concept and you've passed survival, right? And maybe I would say if you don't have a good bookkeeper, this is assuming you have a good bookkeeper, someone you like, someone with the heart of a teacher, someone that you can trust that's going to take care of your business. You may not need that CFO type level till you're $1 million, $2 million. To me, the CFO is adding the most value when maybe you're trying to get outside investors, or you need a line of credit, or you need an introduction to someone. CFOs are relational more so than accountants, and they're also having that forward-looking piece. So to me, if you've just been the solo owner this whole time, but you're considering a partner or some type of legal entity change, that's also I know you would think like, oh, I'm going to call an attorney, and they're great too. Like they are going to be part of the process, but that CFO type person can help you strategize in what is your ultimate goal here, and how does that impact the business?
One last question, and then we'll get to the speed round. So many of the people that I know, they are shocked by how much or how little their company is actually valued. And it's like they put all their effort and all their cash and everything into a services business, and they go, look, I'm doing $1 million a year now. I can clearly sell this thing for $10 million. And you have to inform them that a service business multiple is 0.9, meaning you actually sell it for less than the revenue that you bring in every single year. And then other people that I know are shocked on the other side. How do I keep that in mind, and particularly for my planning? So I now start to talk to you. Is that something a CFO or fractional CFO can help me understand?
Yeah, they can look at benchmarks of other industries, of, kind of give you a range of what those multiples could do. I would say, just as a founder, educating yourself on what's happening with other companies that are similar market, similar industry, keeping up with the industry news. I think, I kind of liken it to a restaurant. So when a restaurant says that it's changed hands and it's under new management, what happens to that restaurant? Their sales typically dip. Some menu item that someone loved is off. And so there's this churn that happens. And so that you're not capturing generally 100% of the value. Are you that restaurant owner? Is there something that you're doing that is only critical to you? Like, you're the mojo of the entity. If you were to sell it and leave and walk away, and most of the time you might have to be there for a year or two, but how much value can you unlock by not being you? Right? Anthony and Chris don't want to have to keep going there every single day to secure the value. And so really working yourself out of a job.
I think it's a good place. All right, Sarah, are you ready for the speed round? It's so dramatic. I feel like
you ruin it every time you play it, and then you ruin the drama.
I'm just getting so excited about this round. All right, Sarah, P&L cash flow statement. Which should you check first, P&L or cash flow statement?
Cash flow statement.
Should founders outsource financial analysis or learn it themselves?
Learn the basics themselves.
Is it better to review financials weekly, monthly, or quarterly?
Monthly.
Would you rather have perfect financial records or perfect sales records?
Perfect financials.
Does a founder need to understand GAAP accounting principles to run a successful business, or can we just handle it with cash?
You do not have to understand GAAP. There's an in-between.
Yeah, I agree. I don't want to understand GAAP.
I was like, do you want to take a CPA exam? I'm not expecting someone to be a CPA, but at a high level, they need to kind of understand. Sure.
Yeah, fair enough. All right, founder fundamentals. Where are we? Or Anthony, what did you learn from today's episode? What are the founder fundamentals? What are you taking away?
So I'm going to summarize a lot of what I heard today with something that a curmudgeon-y old investor once told me, and he's a little bit misogynistic, but it really does kind of underscore the importance. He looked at me and says, Anthony, money is like a woman. If you ignore her, she will leave you. And I love that positioning of it. So that's what I'll that's the fundamental is that just get in and understand that the balance sheet shows a company owns what the company owes and the owner's stake. P&L shows revenue, expenses, and resulting profit or loss. And the statement of cash flows tracks actual cash moving in and out of the business. Those are the basics. Go and make those things your best friend and review them at least monthly. Yeah.
Well, whatever dog that is, totally agrees. Deep dive financial intelligence for entrepreneurs, Karen Berman and Joe Knight. Profit First by Mike Michalowicz.
Yes.
I'm going to say that. Did I get that right?
Yes.
Say his name. Oh, that's excellent. Simple Numbers, Straight Talk, Big Profits by Greg Crabtree. And there's an article called The Future of Financial Reporting, Real-Time Insights, and it's in the McKinsey Quarterly. We love all the big consulting firms here on How to Founder. Sarah, terrific conversation. Thank you so much for joining us. Where can we learn more about you? Where can we find resources? How do we get in touch?
Yeah, everything we do is under Webb CFO, WEBBCFO.com, and all of our social media handles. So we're sharing information. I think this week we're talking a little bit about the cash conversion cycle. So that's kind of out there of, understanding what that is and how that impacts your business. But I think, as a founder, you're a sponge, right? Like you're trying to figure out how your business is working, as well as gathering as much information you can to make good decisions.
Love it. Thank you again so much, Anthony. What do we have coming up?
Coming up, so yeah, Sarah, first of all, thank you so much for walking us through what we need to care about with financials. Yeah, next time. Next time we're talking about, Chris, we're going to be talking about this notion of first order principles. I hear, you need to be thinking in first order principles. It's like, what the hell does that mean? Like, so we're going to talk about what that means with guest Robin Waity. So that's we're off Thursday, Chris. We're coming back on Tuesday, so we get a little bit of reprieve. Everybody that's listening, thank you so much for tuning in. Remember to visit us at howtofounder.com so you can subscribe to us on Apple Podcasts. Leave Chris a 5-star review. You don't have to worry about me, but leave Chris that 5-star review for us on Apple Podcasts. Until next time, thank you so much, guys. Thank you, Sarah. Thanks again. Bye.
Thanks.